the letter being followed, but not the spirit. Now, that's a very critical and a very fine line, right? Now, as proxy advisory firms and as somebody who knows the innards of companies because of your background also as a ratings person, how would you differentiate that, and what are the guardrails you think which shareholders, the minority shareholders who really depend on your protection in that sense, or rather your, flagging off the problems, how would you look at those?
So I'll kind of just supplement what Mr. Bajpai and Mr. Gupta said, and then I'll kind of go on to answer your question. So when we look at it, we kind of see the changes in three pillars. One of them, which both of them alluded to, was the change in regulations. They're a lot tighter. So if you look at the Companies Act, which Mr. Gupta spoke about, one of the ways is that you did have e-voting, but you also introduced majority of minority. Over a period of time, SEBI's come up with their LODR, tightened it. They had the listing agreement, which kind of gave way to LODR, so it's kind of a lot easier to bring in some regulatory changes, and that has been kind of done by way of what are special resolutions, what are ordinary resolutions, and they're important because both of them have a different threshold at which resolutions get approved. With the ordinary, it's 50%. With the special, it's a higher threshold, so you need 75%. And therefore, there are a constant set of changes. The Kota committee came in, which kind of had its own recommendations. Mr. Gupta and I were both members of it, and one of the focus areas was that, look, there are some gatekeepers, which are the auditors and the independent directors, and therefore they should have a greater role and responsibility. So I'd say at one level, it has been the regulations. The second is, what is important is in this whole period, the ownership pattern of companies has also changed. And that needs a bit of emphasis, because if you go back and you look at the market, I'm looking at it in terms of market cap rather than the absolute number. If you go back to just before the financial crisis, the Indian promoters held about 60% of the equity and the institutions held about 20%. So for every 3 shares which was held by the promoter, 1 share was held by an institutional investor. Today that ratio is 35% with the institutional shareholders, 50% with the promoters. And therefore, it's 1.5:1 or 1:1.5, depending on how you're measuring it. So that equation has changed. So the institutional shareholders have started sitting on the high table, so to speak.
And do you think, just to add to what you're saying, do you think institutional shareholders are also becoming much more involved?
Yes, they're much more involved. And I'll just come to that. But you know what that 35% means, and the size of the market, which was alluded to in the earlier session, is that you've got investors with deep pockets. So earlier, when we started, an investor held 1.5% equity. So the promoters would say we can ignore them. Now you've got people with 8.5%, 10% equity. So it's not so easy to ignore. So that has also become a large part. So the whole fact that the institutional framework has changed, and they're much, much more involved now. So I remember when we started, you did not have e-voting. We went, I remember we'd gone with an investor to a shareholder meeting where it was show of hands. And all resolutions got defeated through show of hands. What happened next day, what was filed was that all resolutions got approved. There was nothing you could do. Now with e-voting, each vote is getting counted. Not just that, the institutional investors are much more engaged. And that actually goes hand in hand with what is called stewardship. Stewardship is the fact that, institutions don't own, it's not their money, they're managing money for their unit holders or policy holders, and therefore they have a responsibility. And you find that that is also a part of the regulatory changes, is that stewardship codes have been rolled out. So that has meant that investors are much more engaged. So when we started off, soon after we looked at it, 82% of the resolutions were abstained, 18% were voted. Now, 82% are voted, 18% shareholders are abstained. Coming back to what is it that institutional investors should look at, the opening comment I would say is that there's a general improvement all along. But what investors need to focus on is who are the other investors? The more institutional investors you have, the better you would expect the governance quality to be. They also need to focus a little bit in terms of what the systems and processes are and what the company's communications are. Those which communicate more and better tend to be better governed because they have better grips with their of what is happening. And those who are poorly governed, don't communicate that much.